In May 2025, Fitch Ratings predicted that Dubai real estate prices could drop by 15% this year. You have probably seen that headlines repeated everywhere, but here's the uncomfortable truth. Most external models do not understand how this market actually works, because Dubai is not just following traditional real estate cycles, it's playing an entirely different game. Hello everyone, I'm Archana, your Dubai real estate advisor, and today let's break down this report fact by fact. So first, Fitch sees massive supply hitting the market. On papers, yes. On ground, entirely different story. Dubai's delivery timelines are not driven by spreadsheets, they are driven by execution capacity, regulations, approvals, and labor logistics. Historically, 30 to 40% of announced supply simply does not deliver on schedule. In 2025, Dubai was projected to deliver 37,171 residential units. As of mid-year, 16,631 units have been completed and only 6,265 additional units are on track to be delivered by year end, meaning just 62% of the anticipated handovers are likely to materialize. The outlook for 2026 is even more pronounced. Out of 71,613 forecasted units, only 34,740 are expected to be delivered, equating to just 48% of anticipated handovers based on current construction progress. Second, Fitch models Dubai's population growth at 5%, but those are safe institutional models that remain completely detached from what's actually happening on ground. In Q1 2025 alone, nearly 90,000 new residents arrived. That's annualized growth of 8 to 10%, over 200,000 new residents this year. Let's do a simple math here. With an average household size of 4, that's demand for roughly 51,000 housing units, doubled what's being delivered. Third is tourism. This is where most Western models completely miss the structural difference. In 2024, Dubai welcomed 20 million visitors. That's 9% up year on year. Short-term rental demand in Dubai has become significant permanent absorption layer. Airbnb occupancy in prime districts runs at 72% with yields over 10%. How about London? It's 3%. In New York, even lesser. Dubai's short-term rental economy isn't a temporary bubble. It's now an embedded part of its absorption mechanism. Number 4 is infrastructure, and here where it gets interesting. The 2040 master plan is not just PR, it's policy execution with massive capital behind it. 140 billion dirhams in long-term infrastructure, metro lines, urban expansion, new corridors built for 5.8 million residents. Al Maktoum International Airport, with annual 260 million passenger capacity, is not just an announcement. Construction is already underway. Forecasts that only look at supply without considering how new infrastructure gets built in stages are deeply flawed. They miss how each phase of new infrastructure attracts more buyers and investors, which change how quickly properties get sold, how prices move, and when demand actually shows up. Fifth is buyer's profile, and here's what makes Dubai structurally different today. This is no longer a debt-driven speculative bubble. Over 60% of transactions today are full cash. Corporate relocations, tax migration, family offices, institutional allocations, they are deploying capital into Dubai as a global safe haven. Not because it's affordable, because it's stable. Speculators drove the last cycle. Strategic wealth drives this one. Sixth is the oversupply narrative. Even if every scheduled project delivers on time, which they won't, But still, by year 2029, Dubai will face structural housing shortages. 300,000 additional units are required just to meet base population by year 2029. Oversupply? Not really. The real conversation should be about long-term inventory scarcity. So what's the 2025 reality? Supply remains limited. Population growth is accelerating beyond global forecasts. Tourism continues to absorb inventory permanently. Infrastructure spending is unlocking multi-decade demand hubs. Global capital sees Dubai as political, regulatory, and fiscal safe haven. While Fitch anticipates a 15% decline, multiple private institutional models backed by capital desks actively deploying funds project 8% growth in 2025. Dubai does not trade on noise, it trades on fundamentals that most models were not built to capture. So if you are positioning capital in Dubai and you understand these underlying dynamics, this window may be one of the strongest entries for long-term compounding. If you are serious about capital deployment strategy, reach out for private consultations. Subscribe if you want real data and leave your thoughts in the comments, but with facts. Thank you for watching.